you have a great background, data-driven background. And we would not go too much into the technical details because the purpose of our show is to give value to a lot of high-tech minds who do not have time for themselves, who work 12, 15 hours a day at their job. And after that, they just want to get back home and and then invest passively, potentially, like in the stock market. The stock market is a passive investment. But there are real estate investments out there, which are much more lucrative than stock market. We wanted to understand, get your perspective. What do you say to these people?
Yeah. And I completely understand like this perspective myself, coming as a finance professional before and having invested passively in various types of asset classes, right? And I want to say like one thing I've done, at least at my company, Realty Quant, is like some work on picking markets. So that is a very interesting question. And so what I want to say is like at the current time of, let's say, people having concerns about the recession and so forth, I want to give a positive perspective of being able as passive investors to actually continue investing and do it comfortably and be, not, overly worried and so forth. And some of the approach to that revolves around downside risk. And I discussed that topic extensively before, including with you, Prashant. And so downside risk is really the concept there is, real estate is a fundamental asset. So real estate is, roughly speaking, so it's something comparative to if you have in the stock market, utilities companies or things like that, like sort of value stocks or like companies that are like relatively easy to understand their future earnings and relatively easy to understand their pricing, in comparison to something like Tesla, let's say, just for like high-tech people, like Tesla is something very hard to value, where should the Tesla stock price be? But if we have something like the stock market in San Francisco or in Atlanta, Georgia, or in different markets across the US, it is, in my opinion, and that's something I've been trying to like kind of influence others on, is, in my opinion, relatively easy to understand where it should be valued, like based on its fundamentals of income, population, and housing supply. And so that then gives you once you know this, what they call market valuation, that then gives you a perspective as a passive investor to actually pick markets where they're not overvalued. So and where you're not comfortable, where under any market cycle that is impending, that is change of market cycle that could be happening, you would be comfortable that, okay, your real estate is not going to lose value. Since real estate has a different downside risk profile than stocks, we can get into that more, but it's really a different downside risk profile in the first place, such as it's stickier on the downside, so to say. And so whenever you're in like not overvalued markets, even if you have triggers, like some of the current triggers in terms of higher interest rates, reduction in future home sales, and so forth, those triggers, they do not adjust in pricing so much in the event of like under to fairly valued real estate. And so this is like some of the perspective. I can speak to like some markets that I think are good for that.
Yeah, we would like to hear your perspective, definitely. What I'm hearing you are saying is, because real estate is a fundamental market, right? Everybody needs a place to live. It's not like a volatile stock market. Location doesn't matter in the stock market, but in real estate, location matters a lot. And what I'm hearing from you is you are saying that, if you are in San Francisco or in Atlanta, every market has its different characteristics and you have different data points. And and some of the global data points, like increase in interest rate, does not affect some markets, while it may affect other markets more, depending on the strength of any individual market. Did I say it correctly?
Yes, and I would say dependent on not so much the upside strength of that market, as much as like where is it currently standing in its like valuation profile. Where so for example, like so if we have a market that's overvalued by 20%. Now, okay, obviously that has like some downside risk in the event interest rates go up, and in the event home sales reduce and so forth. If on the contrary you're in a market like many markets in the Midwest and Northeast right now, and let's say it's a market that's 5% undervalued, it's very statistically unlikely that that's gonna be the case. Even if interest rates increase, it's more like your prices, the price are gonna stay the same. So that's kind of the dynamic that I've been seeing based on looking at the data, looking at the history, and that.